All right, welcome guys. It's Marcel here, and here I am with an explanation video regarding the higher time frame strategy. And this is a trade which we took. Me personally took it, and some of you guys also took it. But some of you guys requested this video to explain that why did we set a limit order when the order block could have been found above the 71 level and not below the 71 level. So I'm just creating this explanation video for you guys so you can have a better understanding on why actually did we set the limit order there and why the trade idea was valid. So first of all, let's just start with a breakdown of what has happened or what the trade idea was. So basically price is moving in a downtrend, right? So we had a high right here, we had a low, we had a new lower high, we had a new lower low. And what price did right here is that it basically swept out the previous low's liquidity, right? So you can see that here was the last recent low point. The last recent low point's liquidity got swept out by this huge sweeping movement on this week. So what has happened here is that price grabbed the liquidity of this low point with this wick, and it even closed above the liquidity line, right? So it was a beautiful liquidity collecting wick. And then right after collecting this liquidity, we had basically two options. The first option was to actually create a small movement to the upside, do not break above the high point and just continue to the downside, leaving a new breaker structure behind on this line or on this line, and looking for more short opportunities. Or the second option was that if price will break above the high point after sweeping up the liquidity, which has happened in this case, because right after the sweep of this liquidity, after a small amount of hesitation right here, price aggressively broke above the high point, leaving a really huge volume gap behind. So what we can see right here is that this structure breaking movement to the upside right here has been initiated by the help of this order block, right? So this is an order block which has caused the volume, which is marked right here on the red lines. So this breakout structure has been caused by this order block, and the volume has been caused by the order block again, meaning we have basically all the criteria we need. Why? Because we need 5 or 5+1 criteria for a trade to be valid. Not 11 criteria, not 10 criteria, 5 or 5+1, right? Because the +1 criteria is the liquidation plus, which is basically an extra criteria for the trade to be more valid, to be full probability, full high probability. And without the +1 criteria, the trade is still high probability. So what kind of criteria we had here? First one is obviously the breakout structure, right? So price just broke above the last recent structural high point. Second criteria is the volume, because price broke above this high point with high volume. You can see the volume being created in between the high of this candle and in between the low of this third candle, and really high amount of volume has been created there, because it was like, I don't know, 12 pips of volume. You know, we do not measure the volume in pips. There is not a specific rule for the volume to be measured in pips, but it's just nice to see that the volume actually created a 12 pips gap. So yeah, that is the second criteria. Third criteria is the sweep of the liquidity. You know, the last recent low point has been swept out. Sweep of the liquidity happened right here. Fourth criteria is an order block, because, you know, this is the order block that has initiated the volume and the break of the structure. Fifth criteria is obviously the Fibonacci. We can pull the Fibonacci from the low, which is the protected low, you know, the less recent low point that has swept out the liquidity. So this is the lowest point of before, I mean, this is the lowest point of the movement before the after the liquidity sweep. And we can pull this Fibonacci all the way up to the retracement point. The retracement point will be up here. I will show you some more candles. Yeah, here is the retracement point. And, you know, retracement point is where price literally retraces and starts to move back down to your entry point. So we are pulling up the Fibonacci from this low point all the way up to this high point, and we are expecting an entry on the 0.71 level. But why are we expecting an entry on the 0.71 level when the order block is above the 0.71 level, right? So let me just show you a reference, right? So this is a reference to the high win rate method. In the high win rate method, I state that the method is that simple. We set two limit orders for one trading idea. One is at the usual 71 Fibonacci level, the other at the order block closest to the Fibonacci level, right? In the long example, the closest order block below the Fibonacci level. In a short example, the closest order block above the Fibonacci level. So in this case, this is a long example, right? Because we are looking for a long trade. So in this case, the closest order block below the Fibonacci level. Below the Fibonacci level right here, we can't really identify any order block because there is literally none. No order block can be found below this red line, below this 0.71 level, right? So what we do right here is that we can't apply this high win rate method. We can't apply it because there's no order block below the 71 level, meaning we cannot apply it. The only thing we can apply here is the simple base model, which is entry on the 0.71 level and nothing else. So this high win rate method is just an add-on to boost your win rate. And when it's available, you can use it. When it's not available, but all of the other criteria are there, you can just simply enter on the 0.71 level without using a double risk limit, right? Because this high win rate method only allows you to enter in two positions if there is an order block below the 71 level, obviously in a long example. Once again, if there is no order block below the 71 level, you are simply entering on the 0.71 level without setting two limit orders. So once again, this is just an add-on, right? This is a method that boosts your win rate. And when it's not available, but all of the 5+ criterias are there, 5 or 5+1 criterias are there, you can still enter on the usual 0.71 level. And that's what we did here. That's why I sent you the trade idea. And that's why I did set a limit order here on the 71 level. Because it's still valid. The criteria are still there. We have breakout structure, sweep, order block, volume, Fibonacci. Right here, currently, there is no combined liquidation. Not combined liquidation, but liquidity plus, Right now, there is no liquidity plus. But later on, liquidity plus is getting formed. So let me just show you that where the liquidity plus will be formed. Price mitigated the order block. And then it's creating a range, creating a beautiful range. And at this point, you can see that it has left behind liquidity. So there was basically double bottoms or liquidity trend line. I don't really know or care how you call it. It was liquidity formed above the 0.71 level, which means this trade had 5+1 criteria, which means you can set the limit order here on the 71 level, right? So what we did right here is that we did set the limit order here on the 0.71 level. And basically, that's it. You can choose in between risking 1% here or 2%. Because, if you are using the high win rate method and you are trading on a personal account, then you're risking 1% of your capital on the 0.71 level, and you're risking 1% of your capital on the order block level. In this case, you can choose in between risking the simple 1% right here, or you can double the risk and you can use a flat 2% risk on the single 71 level limit. Okay, it's your decision. It's safer to use the 1% because if there is no order block below the 0.70 level, then the probability will be a little bit lower. But regarding the criteria, if there are 6 criteria available for this trade, you can use 2% too. So it's really your call that if you want to risk 1% or 2%, it's really your own call. That what do you prefer? I believe in this trade, I risk 2%. I'm not really sure, but I believe I risk 2%. Or 1%. I will check it. I don't really recall what kind of percentage did I use right here. Because, I just simply don't remember. But, these are the two options you can have, 1% and 2%. And obviously, if you are trading on a prop firm, you can use 0.5% or 1%. So, basically, that's it, guys. So this is how you approach these situations when there's no order block can be found below the 0.70 level in a long example, or above the 71 level in a short example, right? So you just simply approach the idea with the same confidence, because if there are criteria, the criteria are fulfilled, you can still make money on this trade without having the ability to actually trade the high win rate method. This is once again just an add-on, which makes your win rate higher. Obviously, if you only want to trade the high win rate method, just only trade it. Just trade that single method only. And if there's no order block available below the 71% level, then just skip it. You can just trade this method and you can have a really, really high return by the end of the month. But if you're, I won't say that riskier type of trader, because this is still not a risky setup. This is still a really confident and high win rate method. But if you want to stick to this one single high win rate method where you can set 2 limits, and you want to aim for that high, like 80%, 85% win rate, just use this one and skip these setups. But if you are fine with executing these setups also, just execute them. It's literally this easy. Do not overcomplicate the things. Just go with the flow and follow my instructions. So yeah, that's it, guys. Take care.